Welcome back to International Financial Management. In the previous lecture, we discussed transaction exposure. It is the risk that exchange rates may change between the date of the contract and the date of the actual payment or receipt. To reduce this uncertainty, firms use hedging instruments such as forward contracts and future contracts. A forward contract is an agreement between two parties to buy or sell a specified quantity of an asset at a predetermined price on a specified future date. These contracts are used to reduce the risk arising from unfavorable price or exchange rate movements in the future. The purpose of the forward contract is very simple. It allows the firm to lock in the exchange rate today so that it does not suffer if exchange rates move unfavorably in future. How does it work for different parties? For an exporter who is in long foreign currency, you know you will receive USD in 90 days. You enter into a forward contract to sell USD forward at today's agreed forward rate. No matter what the spot rate is on the day 90, you will sell at the contracted rate. Your INR receipt is guaranteed. For an importer, he knows you must pay USD in 60 days. He enters into a forward contract to buy USD forward at the agreed rate. Again, your INR cost is locked in regardless of how the spot rate moves. This is the power of the forward contract. It removes exchange rate uncertainty completely from a committed transaction. Now, a few important features of forward contracts. They are OTC instruments traded directly between a company and its bank, not on an exchange. This means they can be fully customized to the exact amount and settlement date required. There is no upfront premium. The cost is only the bid-ask spread that the bank charges. They eliminate all rate uncertainty, including the upside. If the rate moves in your favor, you don't benefit because you are locked in. This is the trade-off. In India, forward contracts are governed by FDI rules. Now let us understand this with an example. Suppose an Indian exporter has exported goods to the United States and expects to receive USD 1 lakh after 30 days. The importer will ultimately need rupees because most of the firm's expenses, salaries, rent, electricity, raw material cost, taxes and other operating expenses are incurred in the domestic currency. Hence, the importer is going to utilize the forward contract. For example, if the current spot rate given to us is for how much? Is 83 rupees, and if he is receiving USD, that is dollar 10,000 today, so how much he is going to get? He will get 8,30,000 rupees. But if the USD depreciates and rupee appreciates, and after 30 days one USD is equal to 81 rupees, then what is going to be the income in rupee terms for the exporter? It is going to be 81 into 10,000. So he will receive in rupee terms only 8,10,000 rupees. Now, in order to mitigate this particular risk that he might incur, which is the difference of these two, which is actually 20,000 rupees, he enters into a forward contract, and the forward contract is 82.80. So now he will sell his dollar receipt that he will get after 30 days at a rate of 82.80. So how much he is going to earn? He is going to earn as 8,28,000. So somewhere he has hedged his risk, and now he will not be losing 20,000, he will be only losing 2,000, right? So without hedge, he would have lost how much? 20,000. But with hedge, that is with help of the forward contract, he will only lose how much? 2,000. So he has reduced his risk. But yes, there is also one thing. Now, one thing that we need to understand is, suppose A enters into a contract with B, fine, and A is the exporter. Now, here the exporter has entered into the forward contract, and this forward contract rate has been how much? 82.80, fine. So, he was able to reduce his risk. But suppose what happened if the rupee depreciated further and $1 became equal to 85 rupees. Now, if this was the scenario, then how much he would have earned? He would have earned, the exporter earning in rupee would have been 8,50,000. That means instead of rupee appreciating, if it would have depreciated, then he would have earned more than what he was expecting before. So here, though he has eliminated exchange rate uncertainty by locking at the future rate, but he has also given up the possibility of gaining if dollar strengthens beyond 83, that means the rupee depreciated beyond 83, but is fully protected from the losses if the rupee appreciates. So, somewhere he has done this trade off. He has foregone, the possibility of gaining more if the rupee had depreciated and the dollar had gained while entering into the forward contract, but at the same time he has limited his losses too. Now, let us understand the payoff to both parties in forward contract. For the exporter who is selling dollars forward, if the dollar weakens in future, the exporter gains from the forward contract because he is still able to sell dollars at a higher pre-fixed price. If the dollar strengthens in future, the exporter loses the opportunity to benefit from the favorable movement because he is locked into the agreed rate. For the bank or the counterparty who are buying dollars forward, if the dollar strengthens in future, the bank gains because it can buy dollars at a lower contracted rate. If the dollar weakens in future, the bank loses because it has to buy dollars at a rate higher than the market rate. Thus, one party's gain is the other party's loss. The forward contract simply transfers the exchange rate risk from one party to another party. Now, we have been given the market expected future spot rate in terms of USD euro currency pair, where the exchange rate is $1.15 per euro for delivery in 1 year. And there is an Indian firm which enters into a 1 year forward contract to purchase euro 10,000 at a forward rate of 1.15. A bank acts as a counterparty in the same contract. So, we have been given the realized spot rates, which are very different from what we have expected, and we have to find out the gain or loss for the buyer as well as the gain of loss for the seller. So, if we see in this case, if we see that the forward rate was 1.15, but when the buyer, when the depreciates for the buyer, it is different, while for the seller it is different. So, here we have to find out with the formula of gain or loss, which is equal to realized spot rate minus the forward rate into the contract amount. And here the buyer gains when realized spot rate is greater than forward rate, and the seller gains when realized spot rate is less than the forward rate. Now, here what is going to be the value? This is going to be the buyer's loss. This is going to be the buyer's loss while we will see that the opposite will be true for the seller. For the seller, this much is going to be the gain, fine, because here, why? Because for the seller, realized spot rate is less than the forward rate, fine. So here plus 200 plus 100, so it is going to be the opposite. It is a zero sum gain. Zero sum gain means that if of A is gaining something, then B is losing. If A and B enter into a contract, and if A is gaining, then B will lose the exact amount. Here we see the key conclusion. A forward contract does not remove exchange rate risk, it simply transfers it. The buyer gains when the euro rises above the forward rate, while the seller loses by the same amount. So the total payoff is always zero. If the spot rate equals the forward rate, both sides break even. That at any other rate, one party gains is exactly the other party's loss, which is why this is a classic zero sum game. In short, the contract locks in the exchange rate, but it does not eliminate market risk. Now you may be wondering how this forward rate is actually determined. If you remember our earlier discussion on the exchange rate determination, forward rates are not chosen randomly by banks. They are influenced by fundamental macroeconomic variables, especially the difference in interest rates between the two countries. The basic idea is very logical. If interest rates in India are higher than the interest rate in USA, the investors would prefer to invest in India. As a result, the forward value of the rupee adjusts in such a way that there is no arbitrage opportunity. So, this is the relationship between spot rate, forward rate, and interest rate. And this relationship is explained by interest rate parity conditions, which we have already discussed. Now, if Indian interest rates are high than US interest rate, the forward rate will usually be higher than the spot rate, meaning the dollar trades at a forward premium and the rupee is expected to depreciate. Similarly, if foreign interest rates are higher than domestic interest rate, the foreign currency may trade at a forward discount. Now that we know that the forward rate is determined, we can also calculate the annualized forward premium or discount, which tells us how much the forward rate differs from the spot rate on a yearly basis. So here, let's say we have been given the forward rate for n days, that is, it can be 90 days, 120 days. We have been given spot rate and we have to annualize it and we have to find it whether it is a forward premium or a forward discount. Then this is the formula. So here what we will find it as 85 point. Now here we are going to find the forward premium. So this is the spot rate, this is the forward rate for 90 days, and this is also the spot rate. So we have considered 365 as the number of days. We will number of days in a year. We will divide it by the 90. That is it is a 90-day forward. So we will divide it by the 90. That is a number of days into 100, and we have got this value, which is 3.31% per annum, which means that USD is at an annualized forward premium of 3.31%. We have been given another question in which we have been given the spot exchange rate, the Indian interest rate, US interest rate, and the forward premium. And we have to calculate the forward rate with help of the interest rate parity formula. So a forward 90-day rate is going to be 90-day rate is going to be the spot rate, which is 83 here, upon 1 plus 0.08 into 90 by 360. Why we are doing it 90 by 360? We are taking 360 as the number of days in a year, and 90 day is the period of the forward rate here. So we are trying to bring this particular interest in the quarterly period. So the next is going to be 0.04 into 90 upon 360. So if you remember, we had this formula, forward rate is equal to S naught into 1 plus R D upon 1 plus RF, whereas RD is the interest rate in the domestic currency and RF is the interest rate in the foreign currency. So here we are actually converting these interest rates into quarterly form, and now the 90-day forward that we have got is equal to, after this whole calculation, is equal to 83.82 rupees per USD dollar. Now the next part is to annualize it, and when we annualize it, we use the formula F minus S upon S into 360 divided by N into 100, and what do we get? We get 83.82 minus 83 upon 83 into 360 upon 90 into 100, giving us the value 3.95%. This is the forward premium, annualized forward premium against rupee. A future contract is very similar to the forward contract because it also allows a firm to lock in an exchange rate today for a transaction that will take place in the future. However, unlike a forward contract, a future contract is standardized and traded on the exchanges. When we say that the future contracts are traded on the exchanges, we mean that they are bought and sold on an organized market platforms such as the National Stock Exchange or Bombay Stock Exchange. Let us now understand the differences between forward contracts and the future contracts in more detailed manner. Now that we have looked at both the forwards and future individually, let me bring them together on one slide and walk you through the difference, because this comparison is frequently tested and practically very important. Let's go point by point. First is nature of and definition. A forward is a private bilateral agreement between two parties to buy or sell an asset at a predetermined price on a future date. It's a direct deal, no exchange involved. A future contract, on the other hand, is a standardized and exchange traded. The terms are set by the exchange, not by the two parties. Forward contracts are highly flexible and can be customized according to the exact needs of the firm. The company can decide the exact amount of foreign currency, the exact maturity date, and the exact terms of settlement. Futures, in contrast, are standardized in terms of contract size and maturity date. In forward contract, there is no fixed size. The amount can be exactly matched to the firm's foreign exchange exposure. In future contract, the contract size is standardized and expire only on standard dates, such as the last date of month or specific quarterly dates. Forward contracts are traded over the counter, also known as OTC. This means they are negotiated directly between the company and the bank, usually through telephone, email, or electronic dealing system, while future contracts are traded on organized exchanges. Buyers and sellers do not directly deal with each other. Instead, all transactions go through the exchange and the clearing house. This makes the process more transparent. In a forward contract, there is always the possibility that one party may fail to honor the contract. Since it is a private agreement, the other party depends entirely on the creditworthiness of the counterparty. Suppose a company enters into a forward contract with the bank. If either party fails to honor the contract, the other party may face losses. In a future contract, the risk is much lower because the clearing house stands between the buyer and the seller. The clearing house guarantees settlements and ensures that both parties fulfill their obligations. Therefore, future contracts are considered much safer from the perspective of the default risk. Forward contracts do not usually involve an explicit fee or commission. The bank earns through the difference between the buying rate and the selling rate, known as the bid ask rate. Future contracts may involve brokerage fee, exchange fee, and other transaction cost. In addition, the trader has to maintain margin money. Forward contracts are private agreements and therefore are less regulated. In India, foreign exchange forward contracts are governed by the rules of Foreign Exchange Dealers Association of India, while future contracts are more regulated because they are traded on exchanges and are monitored by regulatory authorities. Exchanges have strict rules regarding trading, reporting, settlement, and margin requirement. Normally, no upfront payment or security deposit is required in the forward contract. The company only agrees to exchange currency on the maturity date. In future contract, however, both parties are required to deposit margin money. This margin acts as a security deposit and helps ensure that losses can be covered if the market moves unfavorably. Forward contracts are not settled daily. The profit or loss is calculated only on the maturity date. When the contract is finally settled, the future contracts are marked to market every day. This means that gains and losses are calculated daily based on the changes in the future prices. If the market moves in favor of the trader, money is added to the margin account and the margin account acts as a security against the default risk. If the market moves against the trader, money is deducted from the margin account. If the margin balance falls below the minimum level, the trader receives a margin call and must deposit additional funds immediately. Forward contracts are less liquid because they are private agreements and cannot easily be transferred to another party. Future contracts are highly liquid because they are traded on exchanges. A trader can easily enter or exit a position by buying or selling a contract in the market. Both instruments effectively eliminate exchange rate uncertainty. The choice comes down to the firm's specific circumstances, the precision of its hedging requirement, and the relationship with banks. With the forward contract, you can always hedge as per your requirement. For example, if suppose you have to hedge a foreign currency exposure, let's say foreign currency exposure of $83,750 for after 27 days. This can be easily done by the forward contract. But with the future contract, you need to have a particular size, which is lot size, and also the maturity date. It cannot be customized. It is very standardized. So the lot size can be 1000. So if you want to hedge 83,000, you will be able to, you have to take at least 83 contracts, but still you will not be able to hedge this $750. Now let us understand the example of mark to margin. And the Indian importer is due to make a payment of USD 1 lakh after 90 days for goods imported from the United States. And to hedge the risk of Indian rupee depreciation, he enters into a 90-day USD future contract. And we have been given the following details. We have been given the contract size, the future rate on day 0, initial margin and maintenance margin. Now we have to calculate contract value, initial margin, maintenance margin. We have to prepare daily mark to market statement, and we have to identify that on which day a margin call is triggered and how much amount has to be deposited, and we have to show the revised margin account balance from the day of the margin call onwards. Let's talk about the answer for the question number 1. What is the contract value? Contract value is equal to 1 lakh into 84.50 So this becomes 84,50,000 rupees. Now what is the initial margin? We have been given the initial margin as 8% of contract value. This is equal to 0.08 into 84,50,000, giving us 6,76,000. Now we have been also asked to calculate maintenance margin, which is 75% of initial margin. So here it is 0.75 into 6,76,000, which gives us 5,07,000 rupees. Now we will do the daily mark to market. We have seen that the future rate has now changed here. The future rates, that is the spot rate, future spot rates are now changing. Those future spot rates right. So how we will do it? Since this is the rate which is already, which will not change actually, because our 84.50, but when it goes down, so here we have seen that the rupee is appreciating and this is the loss the trader is going to incur. Now how I have got it? I have subtracted these and this figure from this figure and I got minus 0.50, and here we have minus 0.30, and then the rupee again started appreciating. So here the appreciation is of 30 and here the appreciation is of plus 0.20. Now if we have to calculate the profit and loss, then it will be according to our contract size, which is $1 lakh. So here there is no loss, but here there is a loss of 30,000. Again there is a loss of 30,000, loss of 50,000, loss of 50,000, loss of 30,000, then gain of 20,000, and again gain of 20,000. Now we are going to understand what is going to be the margin money. At the 0th period, the trader is going to deposit 6,76,000, which is the initial margin which is being given to us here, and then we will keep on adjusting the profit and loss with this particular margin. So here, since there is a loss, we will reduce it by 30,000, and hence the new figure comes out to be 4,46,000. Again there is a loss, the new figure is going to be 6,16,000. There is a further loss of 50,000, which gives us 5,56,000. Then a loss of again 50,000, which is 5,16,000. Then again we have got a loss of 30,000, which gives us 4,86,000. Now this is the amount which is remaining in the margin money. Now till the margin money is 5,07,000, we do not trigger any margin call. But since it has gone down than this particular rate, 5,07,000, then we are going to initiate the margin call. So here we will initiate the margin call. So there the question is whether the margin call will be initiated. So here there is not going to be any initiation in the margin call, but when it goes below the maintenance margin, the maintenance margin is how much? 5,07,000, then we are going to initiate the call. And here we have initiated it. The next time how much margin money we are going to initiate it, that is the question. That is how much money we are going to ask for. Now here we have 4,86,000 with us, and the initial margin was 6,76,000. We have to bring back the margin balance back to the initial margin. So the total money that we are going to ask from the trader is 6,76,000 minus 4,86,000, that comes out to be 1,11,000. 90,000. So, this is the money that we are going to ask in the margin call to make it back to the initial margin, and hence we will have here 4,86,000 plus 1,90,000 plus the 20,000 that we have got. So, here the total comes out to be 6,96,000. Now, again there is an addition of 30,000. So, here it is 7,26,000. So, this is the margin balance. Well, we have discussed about forward and future in details. In the next lecture, we will understand how options work. So, that's for now. See you in the next lecture. Thank you.